Joining me now, Post 9, Mark Okada, Sycamore Tree Capital Partners. Welcome back. It's good to see you.
Good to see you, Scott.
So the Fed has been everything to you in your view of the market and how it's changed.
Yeah, sure. I mean, the move that they announced in December was massive, because if they're going to stop leaning on the market and then think about when they're going to cut next, that's the price of money. And the price of money determines everything that we do.
Don't fight the Fed.
Yeah, that's pretty simple. I mean, I'm a credit guy, so we got to do simple things, right? It can't be too complicated. Just the big picture. When the Fed's not in your face, that's a good thing. Let's go get some risk. And it's been a good call. A great call.
No, for sure. Do you think he goes a step further on Wednesday, Chair Powell, and sets the table? I've been using that sort of phrase, sets the table for cuts in September?
I hope so. It gets priced in, and it's all priced in.
It's all priced in now.
Yeah, I mean, that's already priced in the market. All these valuations we see are betting on a September rate cut. If it doesn't happen, it's kind of upsetting. Or even if they did it this week, which we won't, that would be upsetting too, because that means they see something that we don't see.
Well, there's no reason to see anything that we don't see, right? I mean, inflation's been coming down, labor market's been softening. Yeah, kind of getting everything that they really needed to have happen, no?
Sure. Yeah. Yeah.
So when you say it's a good time for risk, where?
Well, you know, I'm a credit guy, so credit's been good. The call was based on fundamentals. It was based on yields. It was based on liquidity. So this would surprise you, but the amount of distressed debt outstanding today is less than pre-COVID. And with all the people coming on, they're talking up their distressed debt funds. I mean, it's a little disingenuous, because we have less distress now than we had pre-COVID. So that's fun. And interest coverage is actually fine. It came down a little bit, but it's kind of normalizing. So that's fundamentals. You can't get in trouble with those things happening that way. So these are obvious things, right? We're talking about a credit guy. Second thing would be yield. Spreads are tight across the board. Leveraged loan spreads are kind of in the 50% mark, but when you look at yield, just the earnings yield on IG is better than the S&P earnings yield, so that doesn't happen very often. And also, the yield on a lot of the stuff we do is in the 80th, 90th percentile for all time. I've been doing this a long time, and if I can make 6 or 7%, I'm like having to take a lot of risk to do that, Scott. Right now, we can make 8, and we're not taking that much risk.
So you're not thinking that we're going to have a recession, that things are going to get bad to the point where spreads widen and all that stuff?
No, we don't see it. The GDP numbers, the PCE, even the labor stuff and the consumer stuff looks like it's weakening, but it's weakening from a pretty strong place. I don't see the recession anytime soon, and people come in and talk about it, but I don't see it, and so we don't see that. And then liquidity is the last piece. It's been good. A lot of flows into a lot of things we're doing. When flows are coming in, that's always good.
How many cuts do you think we're going to get?
That's a great question. I think that they do, once they start this, they need to be measured, because the reason they're doing this, right, is they see maybe some cracks in the labor market, and they've done their job on inflation. So one and done wouldn't seem to work that way. I think at some point we'll get 2 or 3 of these, and if we get 75, 100 basis points of cuts, that wouldn't surprise me per se. What would surprise me is if they went beyond that. I think we would be in a recessionary environment if they went beyond something like that.
Oh, they do it because they have to, right?
Right. The economy and the labor market would be forcing their hand.
How does, I mean, you've called yourself a credit guy with good reason, but how does a credit guy view the stock market today, given all that you just said about what looks best to you in your own sort of genre?
So this latest correction has been getting some attention from where we sit. So the move has been pretty amazing. I'm trying to figure out where that's coming from. People come on here, they talk about earnings, they talk about the rotations. The one place that I think that seems to make sense to me is what's happened with the yen. So on July 10th, 11th, the Bank of Japan probably intervened. We don't know. They won't tell us. But the yen has moved 5% from that date. That's the only big sort of macro move that I've seen that would explain any of this, because short yen, long tech has been a really popular trade, because the one outlier globally in the whole world is the Bank of Japan with their rates. It's been rock steady. So borrowing in yen to invest in anything risk has been working great, and it's a levered trade. But you move 5% in the yen in a 3-week period, you're going to take out a lot of those yen carry trades. That seems to be kind of interesting to me. It seems early, too, because the amount of shorts still in yen is pretty big. So that liquidity drain, that forced selling out of the yen carry trade could keep going. So I pay attention to that.
So you think that could have a little more pressure on performance of tech?
Feels like it to me. I don't know. I'm not a stock guy, but
no, but you see
does.
all things in all markets. So you can see something in one market which has a cause and effect, as you're suggesting it does to another.
Exactly. And the other thing is the sort of volatility we have across a lot of things that we thought were set. We thought the election was set. The election's not set. We thought we would know what policy would be between these two candidates. That doesn't seem to be set. So there's a lot of political volatility that the market has to deal with right now, and I don't feel great about that. And then we could talk about the whole debt debacle and the Liz Truss moment and the potential for that, but that seems to be getting worse and worse, and the bond market seems to not care. And I hope it never cares, but at some point, if it starts to care, Scott, that's going to be quite something that everybody's going to need.
I know we do get a respite today. I mean, the Treasury says, a short time ago, they're going to borrow less. Yields take a little bit of a move lower from where they already were.